thanks to everyone for joining us today. I'm Bob Fontana, the Chief Investment Officer for Investors Trust, and I have with me today Adam Morgan, our Director of Investment Strategy. We have prepared remarks that should last around 20 minutes or so. This is the first time we've tried a conference call like this, so hopefully things go smoothly. Admittedly, we are doing this under less than ideal circumstances with Adam and I in different locations, but we do hope to continue this effort going forward. We are doing this for you, so we would welcome any feedback that you may have to help us do this better in the future. We are trying to thread a somewhat difficult needle today with what on the surface appears to be inconsistent messages. On the one hand, the economy is hurting badly, and we expect things to get worse. And on the other hand, we believe strongly that our clients should stay invested in the markets. So hopefully we were able to explain our reasoning behind that well. It remains hard to believe how swiftly things have changed, as the market hit an all-time high on February 19th, less than 2 months ago, when the economy was on track to grow about 3% or so. The agenda for today will be first, Adam will talk for a few minutes about the mechanics of the markets. I will follow that up with a discussion of the economy. Adam will then discuss some of our asset allocation changes, and I will mention some of the things we have done within our individual equity portfolios. We will conclude by answering your questions. We do thank you for the questions that you submitted beforehand. We will do our best to answer all questions. If we run out of time, we will follow up with you subsequently. By all means, please do not hesitate to reach out to us with any additional questions you may have after the call. With that, let me turn things over to Adam to discuss the mechanics of the market.
Good morning, and thank you all for joining us. Before Bob dives into our outlook going forward from here, as a way of making sure that we're all starting on the same page, we thought it would be important to discuss a few aspects of the stock market as well as economic reporting that are going to be very important to keep in mind as we watch events unfold in the coming months. First of all, the stock market and the economy are not the same thing. That may initially sound obvious, but during a crisis of this kind, it's especially important to note the forward-looking nature of the stock market versus the inherent lag in the reporting of most economic data. The stock market is a forward-looking entity, constantly in search of accurate pricing of future prospects. Market participants derive a value on financial securities by forecasting potential future cash flows and then discounting those cash flows back to time zero or present day. All that means is that stock market investors are more concerned about the future, which is to some degree unknown, than present day, which includes all of the known information. One can think of several examples of this from just this past few years. As an example, stock market investors who believed that President Trump would enact policies that were favorable to business and ultimately stock prices didn't wait for those policies to pass through Congress before investing. Most didn't even wait for him to be inaugurated in January of 2017. Instead, many began investing the morning after the election in November of 2016. In fact, Congress didn't pass the major tax overhaul, which included corporate tax cuts, until late 2017. So investors that waited until that day to react to what most knew was coming missed out on what was roughly a 28% return in stocks. And this is not to suggest that the stock market is always right, quite the contrary. In December of 2018, the stock market declined dramatically because a consensus of stock market investors, including many well-known economists, had become convinced that the U.S. economy would fall into a recession at some point during the following year. That didn't happen. And in fact, the stock market ultimately rallied another 39% from the low on December 21st, 2018, to the pre-coronavirus high in February of this year, 2020. Academics, strategists, theorists, and the like have debated and written a lot about just how forward-looking the market is. And we'll save that conversation for another day. But the basic concept is an important one, an important thing to understand, especially today as we watch the stock market debate just how long it might be until our lives and the economy return to some semblance of normalcy. Another important factor to consider is the time lag inherent in most economic reporting. Let's take GDP as an example. GDP, or gross domestic product, is a measure of how much commerce is occurring in our economy, but it's reported with a lag. So while we've all heard that our economy is going to take a hit in the second quarter of this year, months April, May, and June, the confirmed and final statistical severity of that hit won't be known until late September when the U.S. Bureau of Economic Analysis releases their final second quarter GDP report. Further complicating matters, if a recession is technically defined as 2 consecutive quarters of negative GDP growth and the lag in reporting is up to as long as 2.5 months after the last month of the quarter, then it is quite possible that we won't receive actual confirmation that we were in an economic recession until it is over. So the string of bad news may still be making its way through our 24-hour news feed at a time when we're hopefully living in a much better and much stronger economy. And because of the forward-looking nature of the stock market, the market won't wait for the day when bad economic data reported with a lag turns good. While there are economic variables that are better leading economic indicators than others, it is important to recognize the juxtaposition between the time frame the market is working on versus the time it takes for economic events to unfold. Now, add in the coronavirus and things get especially complicated. The coronavirus has led most developed nations in the world to effectively shut down major parts of their economies. And that has led to an economic shock that is more dramatic and more sudden than even the financial crisis of 2008. Then the unemployment rate in the U.S. increased 5 percentage points from 5% to 10% over a 2-year period. Now, the ultimate effect is more dramatic and is occurring over only a 2 to 6 month time frame. But unlike then, when the problem with the economy was systemic and the recovery was sure to extend for some duration of time measured in years, the coronavirus is transitory. At this point, no one can be sure exactly how temporary the effects of this virus are going to be on our society and our economy, but most would agree that at some point we will return to some level of economic production commensurate with a lifestyle that includes all of us safely going back outside and resuming our normal life and workflow. So while the juxtaposition between the stock market and economy and the speed of impact but transitory nature of the coronavirus make this situation somewhat more daunting, we think these are important elements to keep in mind as Bob walks us through our outlook on the economy and markets going forward from here. Bob?
Thanks, Adam. It is important to understand the mechanics of the market, especially in light of the current economic situation. As we shared in our latest market update, the economic data has just begun to turn quite bad. We expect the economic headlines that will be coming out in the coming weeks to be disastrous and understandably alarming to all of us. This is the first time in our lifetime, if not in history, that the government has essentially shut down most of the economy on purpose, doing so obviously in response to addressing the health concerns associated with the new coronavirus. How bad is it, and how bad can it get? Initial jobless claims, which come out every week, have totaled over 22 million over the past 4 weeks. That includes a recent week in which over 6.6 million jobless claims were filed, which is about 10 times worse than the previous weekly record of 695,000 that was set back in 1982. Monthly payroll gains, which had been chugging along quite steadily, with monthly gains in the 100 to 200,000 range for the past 8 or 9 years or so, turned negative in March, with job losses totaling over 700,000. We expect April numbers to be much worse. The initial jobless claims data suggests that there could be over 20 million job losses in the month of April. Those numbers are outright staggering. The unemployment rate, which had been essentially at its lowest levels since the late 1960s at around 3.5%, rose to 4.4% in March and could be on track to exceed 20%. The U.S. is a consumption economy, so the level of consumer confidence really matters. The level of job losses, even if they are the result of government orders to shut down business and for us not to leave our homes, that really matters. So we expect to see a huge impact on our economic activity. We believe it's entirely possible that economic growth declines by over 25% in the second quarter, and it is likely that economic growth will be negative in the third quarter as well, albeit likely much less so. At present, we believe that the economy may start to turn positive at some point in the third quarter, even if the entire quarter itself may not be positive. This would pave the way for some positive growth in the fourth quarter. Obviously, the timing of the resumption of economic growth will be dependent upon when the medical community and government tells us that we can start going back to work and begin the process of living our normal lives again. Now, the government's pulling out all the stops to try to deal with this transitory shutdown to our economy. As shockingly bad as the economic data may be forthcoming, the amount of stimulus that the government is in the process of infusing into the economy is unprecedented and equally staggering. What has been done? The Federal Reserve, which has the ability to act more quickly than Congress, has announced measures that have or will be injecting roughly $4.8 trillion into the economy via the creation of numerous bond buying and credit facilities, the details of which we won't go into here. In addition, the government passed a roughly $2.2 trillion fiscal package through the CARES Act, which includes front-end loaded funding for a wide range of things, including unemployment benefits, direct aid to small businesses, loan guarantees, assistance to some of the hardest hit industries like airlines, assistance to state and local governments, among other things. Combined, the government stimulus currently is in excess of $7 trillion. Putting that into perspective, our economy was running at over a $20 trillion annualized rate. So this stimulus equates to roughly 35% of our overall economy, and the government is prepared to do more if needed. Admittedly, the distribution will undoubtedly be messy, and we will all hear about stories of people or small businesses that did not get assistance in time. But from a larger economic perspective, this unprecedented stimulus will be a major help. With that said, we believe the market currently expects really bad economic numbers. That's the primary reason why stocks came in so sharply, as the street went from expecting relatively healthy economic growth to an outright disastrous decline. So if indeed you see the headline that the economy declines by 25% or more in the second quarter, or that the unemployment rate jumps sharply to some previously unthinkable level, that is already expected by the street. At the risk of sounding cold, the street may not care whether the economy is down 25% or whether it's down 30%. It may not care if the unemployment rate jumps to 17% or to 22%. All of those numbers are really bad, and really bad is what the street is expecting. What the street does not know is what the fallout from the shutdown of the economy will be. In our most recent commentary, we called those the domino effects. How many businesses, even with some forms of government assistance, will still not be able to reopen? As we mentioned in our commentary, estimates suggest 15% of all restaurants may be permanently closed, and that includes some household names. Recently, we got some takeout from Red Lobster, and the person who brought the food out to our car said that several of the other Red Lobsters around Charlotte had already been forced to shut down. She was thankful that they were able to at least stay open because their takeout business was okay. I can assure you that not all Red Lobsters that have been forced to close during this time will be reopened. We know that many retail stores will not be able to reopen. The estimates we have seen have been in the 10 to 20,000 range. Even large chains, if there were stores that had been underperforming, they may only reopen briefly to have a going out of business sale, then shut the doors down permanently. Even if employees of those organizations receive government assistance for the next couple of months, what happens on the backside? Will the housing market, which had been quite strong with low interest rates and low unemployment rates, be able to bounce back in 2021? Or will potential homeowners be more conservative with their spending? For what it's worth, both new and existing home sales through February were on a monthly pace of over 6.5 million, but data from March had not yet come out. Will auto sales, which had been running over 17 million per year, be able to rebound? For what it's worth, auto sales dropped to an annualized rate of 11.2 million vehicle sales in March from 17.2 million in February. Will there be a renaissance in U.S. manufacturing as companies seek to relocate some of their production back into the perceived relative safety of the U.S.? Certainly, some manufacturing of health-related items like masks, ventilators, and even drugs will come back to the U.S. in order for us to be better prepared in the event another such crisis occurs. These are some of the things that we will be watching as we get through the current crisis. So we do want you to be prepared for some shockingly bad economic numbers in the coming weeks. And remember, it is the media's job to get you to read their papers, watch their news shows, and click on their internet stories. So those headlines will be even more sensationalized to get you to do so. Amidst this backdrop, we have certainly been thinking about what things may look like on the other side and trying to reposition portfolios accordingly. That has included changes to asset classes that we once thought were attractive and changing some areas within our individual equity portfolios as well. Before turning things back over to Adam, let me remind you that we have built portfolios in each of our client accounts that are specific to your circumstances. So some of the changes that we discuss may not be relevant to your account. With that, let me turn things back over to Adam to discuss the changes we have made within the asset classes of our asset allocation. Adam?
Thank you, Bob. While we'll always continue to preach the benefit of diversifying investment across a range of investments that span various industries, sectors, geographies, and asset classes, we also want to balance our desire for diversification with the reality that not every investment is positioned to recover immediately and or prosper at the same time or same rate post the coronavirus crisis. The investment team at Investors Trust has worked to identify opportunities in the investment landscape that we believe will do very well in our new economy, as well as areas that we believe will simply take too long to recover. So with the goal of shifting investment away from troubled sectors to reinvest into more productive investments, we chose to eliminate our investment in two areas of the economy that we no longer favor. The first of those areas that we exited are MLPs. MLPs, or Master Limited Partnerships, are an infrastructure of pipelines used to support the transport of oil and natural gas. They make money by charging a fee for the volume that travels through those pipelines. They work much like a toll booth on the highway. And because so many people today are isolating, which involves working remotely from home, the demand for oil and gas has dropped significantly in a very short period of time. Now imagine that you owned a toll booth on the highway and you saw the number of cars traveling through your toll booth drop dramatically. The toll booth would therefore be worth less money. Essentially, the same concept applies to MLPs. Couple that with some recent decisions from OPEC that are emblematic of a series of challenging negotiations between Saudi Arabia, Russia, the United States, and other oil-producing nations, and that investment no longer displays the characteristics that originally attracted us to it. And while we don't believe that the oil and gas business is going away anytime soon, we just saw better places for investment dollars elsewhere. The second investment that we sold are REITs, or real estate investment trusts. The reasons for exiting this sector of our economy are twofold. One, the steep drop in demand is undeniable. And two, the likelihood that this sector will recover to the same level of strength seen earlier this year decreases with every passing day that this crisis continues. Sticking with the local restaurant-themed analogy, consider all the restaurants that have been forced to shut down. In most cases, the restaurants do not own the land that they operate on. They lease that space, and oftentimes from a real estate investment trust. Because of the restaurant closings, many restaurant employees are going to struggle to pay rent in their personal apartments or condominiums. And many of those apartment complexes are also owned by real estate investment trusts. REITs also consist of strip malls and retail outlets that have recently seen demand drop to near zero, as well as commercial real estate properties that are sure to experience a lack of demand over the coming months and possibly years, as many businesses learn that they can in fact shift some subset of or all of their labor force to working remotely from home. Some businesses simply won't need as much office space going forward. So this is an example of a sector of our economy that promises to take too long to recover. Traditionally, REITs pay a very nice rate of interest in the form of a dividend, and the well-capitalized, better-positioned REITs may even emerge from this in stronger competitive position at some point down the road. At that point, we may choose to revisit REITs as a suitable investment, but for now, there are better places for your investment dollars. Which brings us to the last leg of our conference call today, as Bob will walk you through some of the stock trades we've placed with the intent of realigning portfolios to take advantage of the post-coronavirus economy. Bob?
Thank you, Adam. As Adam mentioned, we've also done a number of things within our individual equity strategies in order to reposition accounts. First, we exit areas that we thought may be impaired for an extended period of time. For example, we exited several weeks ago anything to do with travel, such as hotels and cruise lines. In our dividend-focused accounts, we had owned Marriott International, which is arguably the best hotel company in the world. While near-term issues have caused their revenue to drop over 80%, we think it may take a while for travel to pick up once we are through this crisis, as business that had previously been done face-to-face may be done more often remotely. In our growth-focused accounts, we had owned Royal Caribbean, which we believe is the best cruise operator. We sold it, as we believe that demand for cruises may take some time to recover. With that said, I surprisingly saw data earlier this week that showed bookings for 2021 that are up over 40% from 2019 levels. So we'll continue to watch that area. We also exited any turnaround situations, as the current backdrop is simply not conducive for successfully navigating a turnaround. That led to exits in such names as Kohl's and Harley Davidson. Where do we put those proceeds? We put them in retailers that we believe will be long term winners and that had pulled back with the market declines. Names like Lowe's and Home Depot, names like Walmart and Dollar General, which also have the benefit of historically being relatively good performers during periods when the economy is challenged. We've added to our healthcare exposure, especially some firms that pay very good dividends following the market pullback. Pharmaceutical companies, for instance, have long been beaten up by politicians for overcharging customers for their drugs. While drug pricing certainly remains a topic of debate, this pandemic will likely lead to less pressure on drug companies because the speed with which they have been developing therapies and vaccines for COVID-19 are, in part, due to the resources they have. That led us to increase positions in such names as AbbVie, Johnson & Johnson, and Pfizer, for instance. In addition, in growth-focused accounts, we've recently purchased a new position in an infection prevention company, as we think the need for infection prevention will likely extend beyond just healthcare once we get through this crisis. We've purchased new positions in companies where we believe the long-term macro fundamentals remain in place, even if the near-term outlook has been hurt. These are areas like 5G and wireless, cloud computing that has been well in place for a while now, online gaming, mobile, graphics. All of these areas require significant computing power that comes from semiconductors. So we have purchased or added exposure to those areas, including such names as Advanced Micro Devices, Applied Materials, Marvell Technologies, and Qualcomm. For our dividend-focused strategies, we have analyzed our companies to ensure that their dividends can indeed continue to be paid. While circumstances can still change, the good news is that there was only one company where we had concerns about the dividend, so we recently sold it. It's still possible that boards may choose to reduce their dividends in order to be cautious, but we currently do not believe our portfolio companies will be forced to cut their dividends. It is possible that in the short term we will lose money on these new positions, as we cannot pick the bottom for any individual stocks, but we do believe that the investments made recently will reward our clients over the next 12 to 24 months. So while our message is clearly that we believe our clients should stay the course, that does not mean that we think it makes sense to sit still and do nothing. The world and the economy have changed, and it's important to adjust accordingly. We will continue to reposition portfolios as we believe appropriate in light of changing data and pricing in the market that may present attractive opportunities. That concludes our prepared remarks, so we'll now turn things over to your questions. Again, we thank you for submitting your questions, and note that we will do our best to get to all of them. If we do not get to your question, we will follow up with you subsequently. And again, please feel free to reach out to us after the call if you have any further questions. From a format perspective, Adam and I will go back and forth asking and answering questions. So Adam, how about you pose the first question, and I'll go ahead and try to answer it.
You got it. We had several really good questions. This first one I thought was particularly good and right up your alley, Bob. Has COVID-19 affected your research process, and how reliable is earnings guidance now?
That is a good question, and thank you for whoever asked it. From a high-level perspective, I don't really think our fundamental research process has changed that much. However, what I will say is the importance of the different things that we do may have changed. And what I mean by that is we are always looking for companies that have good balance sheets, for example. But in the current environment, having a strong balance sheet is critically important since we don't know how long companies are going to have to endure the declines that they're facing now. So having a good balance sheet helps companies get through that. We normally do a lot of work as it relates to earnings. We do still believe that earnings ultimately do drive stock prices. As it relates to the guidance that companies have provided, I would say we have very little to no confidence in estimates for 2020. In fact, a number of companies have already suspended their guidance for this year because they just don't have the typical visibility that they usually do to be able to provide it. In many ways, though, I think 2020 is quickly emerging to be a throwaway year for earnings. That is to say that investors recognize it's going to be poor, and so they're going to start to look to earnings in 2021. I actually think that's already happening now. Normally that would happen later in the year, call it September, October, something like that. but I think now companies are already trying to figure out what 2021 is going to look like, or at least investors are trying to figure that out now. So that's how I would answer that. Let's look at some other questions here. Adam, we received a couple of related questions, and I will throw them both out to you and let you respond. One is, has the market bottomed? Can we go lower? And two is, what should we do with any cash right now? Take that one away, Adam.
Okay. Yeah, I got a fun one. Has the market bottomed? Can we go lower? And what should we do with cash? So let me start with, can we go lower? Yes. Without a doubt, the market can go lower. And in the market can certainly trade lower in the near term on a lack of certainty around a vaccine or a therapeutic. Until you have a vaccine or a quality therapeutic, the market really can, in the short term, drop. And in fact, most of the time, bottoming is a process. And so the market bottomed on March 23rd, around 2250. That being the S&P 500. We're up about 20% from there as we stand today. And the market, what typically happens is, after a steep decline, is there's a rather sharp appreciation. Some people call that a bear market rally, and then the bottom is retested again. So we could certainly, in this environment, get back down to those lows. There's some technical support around the 2400 level in the S&P. Well, look, because I hate it when people in our business don't answer questions directly. I'll say that I do suspect that we've seen the bottom, but in the near term, anything's possible. Without the help of our typical guideposts, that give us a feel for the market, price to earnings valuations, as you mentioned, earning estimates and guidance are off the table. Manufacturing and services survey data, consumer sentiment, small business optimism, all very bad and not very helpful for a time like this. So I wouldn't be surprised if we went lower in the very near term. But the massive stimulus package has gone a long way in helping the market to regain its footing. And so any move down, I would think, would certainly be met with some support from buyers with longer term time horizons. And really, that's your answer to the second part of the question, is what do we do with cash? Well, if you are an investor with a longer time horizon, this is a great time to be investing, regardless of whether or not the market moves down in the short term or not. It's a great time to buy. You don't, one of my favorite sayings is, you don't get low prices and good news. Lower prices are always coupled with bad news. There's always a good reason for a sell-off, and we've witnessed that here. But on the other side of this, we're sure to emerge with low interest rates, lower tax brackets, and an economy that's not fundamentally damaged, at least yet, with crippled banks or an overbearing Fed policy or something like that. So so money invested today, I would think, would yield profits to anyone with longer than a 12 to 18 month time horizon. So let's move on to, I think we're bumping up against our time, but there is time for one more question. Bob, this one's for you. Is China's economic path relevant to the U.S.? And can we believe the data out of China?
Yeah, that's another good question, Adam. Thanks. I'll talk about the data, I guess, first, because we do often get questions about the trustworthiness of China data. Usually it's relating to economic data. So it's certainly understandable to question the coronavirus data. The short answer is, we don't know if we can believe it. However, we do believe are companies that have operations in China. And that is that data, if you will, is encouraging. What I mean by that, Apple had closed all of their stores in China early in the year. All of those stores have now reopened. Starbucks, likewise, they had closed all of their stores early in the year, and the last update we got from them was about 95% of their stores are up and running normally. Nike has opened back up the vast majority of their stores as well. So this does suggest that the economy in China is starting to return to some semblance of normalcy. However, it's maybe a quote unquote new normal. in that we're also hearing that it is now common for them to wear masks wherever they go. Movie theaters may be open, but there's still social distancing that's going on, so people aren't necessarily sitting next to each other and what have you. But it does look like the economy is beginning to return to some semblance of normalcy. In terms of whether China's path is relevant to us, I think it is. I mean, China was the first one to get hit with this coronavirus, and so they're the first ones coming out of it. And it took them about 3 months or so to begin the process of normalizing. For the U.S., that seems reasonable to expect us to begin to normalize under a roughly similar time frame. So yeah, I do think it's relevant for us to consider. So. All right. Well, as Adam said, we've run up against our time here, so we do want to respect everyone's time. Again, we thank you for joining us today. As I mentioned at the outset, we expect to host more calls in the future, so we would welcome any feedback that you have that may help us do this better for you the next time. And again, please reach out to us with any additional questions you may have. And since we will be doing these again in the future, if you have a topic or a question that you would like us to address at some future call, by all means, please let us know. So thank you very much, everyone.